like part 2 of our events that we started on Thursday for those people that are more interested in just learning, the basics of how we trade, okay, and just learning the trades. Today is more of an under the hood type of thing. We're going to explain more about the how and why we do what we do, and how and why it works so well. So this is kind of backwards from what we usually do. We normally do the why and how first, and then we follow up with the what. But yeah, I actually got some emails from people that said they appreciated getting the what first. And so we've got a little bit more of that today, and then we'll go to the under the hood stuff. So the analogy I used was the cars. When somebody says, how does a car work? And some people go to great lengths to explain the workings of an internal combustion engine, and that's what they need to know if they're going to buy a car. They want to know all of those things. And if you ask my wife how a car works, she's going to say, well, it works with a key and gasoline. And so they're both, the answers are both right, depending on what you need to know to determine if this car is right for you or not. So we're kind of going down that same path here. The last session, the Thursday session, was the key and gasoline session, and today is more looking under the hood. So hopefully you'll be patient and listen and understand, and that we're going to go into a bit more of a deeper dive. Not totally deep. It's still going to be just surface, because otherwise this event would be 10 hour long. And I don't think anybody wants that on a Saturday morning. Okay, so let's go ahead and get started. I'm Tony Peterson. I started the Intentional Trader almost 15 years ago. Things have been going really well since then. Didn't really intend to start a trade room or create a trading system that I would share with others, but it just kind of organically formed that way. We're going to talk about today what we do, and that's essentially is pullback trading. And we're going to go over kind of in order here. We're going to talk about some live trades. Okay, so I'm still doing this a little bit backwards. I usually talk about our system and our setups and all that, and how we came about it and the indicators. And then I go into showing live trades so that you'll understand what you're seeing. And I've been doing it that way for many years, but I do know we lose a lot of people that are just like, man, just show me the trades. That's all I need to see. Just show me the trades, show me how they work, and then I don't need to know all the other stuff. So we're going to go over some live trades that we took in the trade room, and I'll talk about those for a few minutes, and then we'll start getting into talking about what happens inside of a trend. And we always get questions about being counter trend traders, and so we'll talk about that, and why does price pull back from the current trend, and the requirements to be a pullback trader, the importance of momentum and momentum traders. We're going to talk about all of the anatomy and characteristics of our pullback trades. Then we're going to talk about the technical indicators that we use for our trades. And then we're going to have a special offer for you guys, which is essentially 20% off of any of our programs. Okay? So let's look at what we're going to be talking about. Again, this is a little bit different. These are trade setups directly from our trade room, and they're in no particular order, or I just grabbed these one day real quick, and I can show you. This is, you can see how on our charts the indicators show up on the current bar. Okay, so there's a lot of misunderstanding out there in the world that says all indicators are lagging. Okay, so that's you hear that, quite common to hear that. These are not lagging indicators. We're measuring every single tick that comes into the market. Okay, every single tick that's coming into that current bar. And the instant a condition exists, it prints on the current bar. Okay? There are a couple of exceptions, and I'll explain those later. But they don't back paint. All right? You'll see back painting happen on our momentum, this momentum indicator where the bars turn black and then they get lighter color. That's because if you think about the term momentum and picture somebody on a bicycle, maybe, and they're going down a hill and they're starting to gain momentum after they have started going down that hill for a while, you'll understand that you don't actually know where momentum started until you already have momentum. And then you can go back and figure out where it started. But it's not momentum until it is. So that's why we have to go back and start and paint where it started. Okay? Now, these are our trade setups that we trade every day in the trade room. We've got indicators popping up, and we're going to go over all these indicators, okay, for those of you that need to know what they are, what they're doing, how they work. We're going to talk about all of that. But right now, we're showing that we have an overbought condition. We have our speed tick, that little white arrow. Where it prints on this bar does not matter, only that it's on the bar, okay? So that's all that matters. And so we have a speed tick. So we have an alert here. And in the trade room, you're going to hear me say, I'm watching whatever instrument this is. Now this is an opportunity to sell right here. So we would sell this. This is called our speed tick trade setup. All of our setups are pretty close to the same thing, but with a few subtle rule differences. Okay, so we give names to each setup so that everybody knows what we're talking about. Right now, price is testing this resistance. Okay, so we shorted it here. Price is testing this line of resistance, which is part of our rules. So we're hoping that price tests it, and then eventually it gives up trying to push across it and drops down. So this was a speed tick trade setup. Okay? Any questions on that yet? You guys are already sitting very quietly and patiently. Have your the Rockstar had no bearing on that trade. It was incidental on that trade. It just happened to be on the previous bar, but it didn't have any bearing on that particular trade because it was a speed tick trade. All right. So we'll go over some more of those here. I'll speed this up so we don't have to watch every tick. Okay. So again, price is channeling, kind of steps up and then drops hard out of that channel. Now we're dropping hard. We've seen strong momentum. We see an oversold condition. We see that we get a speed tick, a pullback alert, and now this bar opened with a rock star. So we put on our buy order at the open of this bar or better, right? So the bar opened here, but price backed up down to here. That's where there was a good chance you get entered in the trade here, okay? So that's even better. The software does that. This is our FT reset or first touch support and resistance lines. We'll talk about those in just a minute. But yeah, these are our lines. It comes with the package. All right, again. And this looks almost identical to the previous trade, right? Price is channel a little bit, drops out of that channel, hard, oversold, speed tick. This bar opens with the rock star. That's where our order goes in. And price pulls back. I think I have some losing trades in here too. So it doesn't happen exactly. I mean, nothing happens all the time, right? all we can do is base things on historically what happens often. Okay? So here we have a rock star where we have the opportunity to sell at the open of the bar, or even better. Okay? Even better. So this is a trade setup. This speed tick has nothing to do with the trade setup. The decision was made because of this speed tick. This bar got us ready. The rock star was the trigger to get into the trade. And I'll tell you what the rock star is in a few minutes when we start talking about the indicators. Okay? Now, we're not expecting a reversal here. I mean, we had a reversal down here, right? This trend was this way, and then it reversed, and it went this way. We're not anticipating a reversal. It could be a reversal. We don't know. But what we do know is, and our expectation is, this trend is going to continue. Okay? So we're only expecting price to pull back a little bit. No, there's no real way to know, Rose. Some people will adjust their entry to the point where maybe they don't enter in the first 5 seconds of the bar and they hope to get a better fill. Typically what happens with me when I get a better fill, it's because I'm watching the chart, right? And then my eyes move to my trading dome, which takes half a second. And in that half a second, price has given me a better opportunity. Good morning. So I get a better opportunity just by that lag of a second or two on getting my order in. I never rush on my orders. I am very deliberate. Now, I've been doing this a long time and I practice a lot. And that's how I get really good. But sometimes, in fact, yesterday, I think twice, trades opened and went to target before I had a chance to even get in the trade. It happens. It just happens. You can't avoid it. All right? It's going to happen. But we're hitting between 75 and 80 something percent win rate. So you just have to let some go. And that's okay. You can't have, I think fear of missing out is one of the biggest problems a lot of traders have. But if you know that you're going to get more setups and you're going to, okay, so I didn't take the trade on this particular, because there was no, it looks like a setup. I'm calling out to the room right now. I will be saying, I'm watching this instrument, whichever one it is. And I'm going to wait, and I'm going to wait, and I'm going to wait for the open of the next bar to make a decision if this is a tradable setup. And as it turns out, it's not a tradable setup. Now, it may go to target. It did go to target. But I didn't take that trade because I didn't have the proper trigger on the open of the bar to enter that trade. I don't wait. It only indicates that I can get a better fill. Because I can see on my dome, there's a little, we put the OTS indicator on our dome. We have a little indicator. And we put that on the dome. So I know where the open of the bar is based on what I see on my dome. And if my eyes shift over and I see that I can get a better fill, I'm taking it. I'm definitely going to take it. And that comes with a little bit of practice. That's all. And hopefully you do a lot of practice, right? If you're in the Fast Forward program, Rose, there are videos on that, on the dome entry and placing your orders on the dome. If you haven't seen those, they're in the Fast Forward program. So those of you that aren't familiar with our trading system, you'll notice the same thing keeps happening over and over and over again. All right, this is not a trade setup. Okay, the simple reason is this bar did not have, it had a speed tick, but it did not have the confluence qualifiers for a, what we would call a naked rock star trade. So this was not a trade setup, okay, because this bar did not have the confluence requirements. If we had, see this dot with the 2 in it? If we had that on this bar, it would have qualified. But it did not qualify, so that was a no trade. Now we're pushing up. Now we're overbought, which is another qualifier for a naked rockstar trade setup. Notice the bar is turning almost white here. That means a exhaustion and a pullback is imminent. It's coming, right? And there's a pullback, but there was no trade for us, no trigger. Again, it happened, but we didn't get the trigger to enter that trade. Okay, so we don't always know everything. You know, that's having an unrealistic expectation when you expect to always know everything when a trade is and isn't going to do something, when the market is or isn't going to do something. That's an unrealistic expectation. This is a rockstar trade setup. Rockstar because it is 5 ticks or less from this support line. And that's exactly what we do all day long. So for those of you that are just visiting, you're just now watching this, does this look almost like the same video over and over and over again? That's what we do. There's no gray areas. It's yes or no. Any questions so far? We can move on. I could show you a million of these. But my intention was just to show you these so that you'll understand what it is that we're going to be talking about now. I'm going to tell you why this works now and why this works so well and why we've been able to do it for almost 15 years now. No questions? You guys, everybody understands this? Perfect. This probably was a loser if you got in this trade. Looks like it hit the stop and then turned around to be a winner. So the point of that is we only have a sweet spot. We don't know exactly what's going to happen on the open of every bar. And guess what? Nobody does, ever. All we can do is get as close as we can get. Okay? We have a tremendous edge, one that's in, that most trading systems don't have. All right, so you look at this now. This, for trend traders, this is you're going to see a bias here, right? You see a bias, an upward trend, right? Pretty easy to see. We have an upward trend here, but inside that trend, notice we have other trends. We have short-term trends, and then we have even shorter-term trends, and then we have medium trends. It depends on the time frame that's important to you. So we get a lot of traders that want to know if we're counter trend trading. I mean, and you tell me. Okay, these are all potential trades right here. There's buying and selling. So are we trend traders or counter trend traders? Does it matter? We're not trend traders or counter trend traders. Our expectation is the short-term trend is going to continue. It doesn't always. Yeah, we're both and neither. Okay, so we don't make any type of distinction between trend and counter trend. What we do is we look for opportunities. And if you look at this, you'll see pretty much the same setup I just showed you on all of those videos. On every one of these arrows, there's almost the same exact setup. So let's look at the anatomy of what's going on inside these trends. We trade 1 minute charts. Yes. Yes, we trade 1 minute. All right, so this is a very typical looking chart, right? You might see this every day. But let's look at what's going on inside of this, or potentially going on. So when price is kind of channeling like this, you have areas of potentially accumulation, okay? So what accumulation is when the big boys are slowly buying up the existing contracts or stocks or whatever for this particular instrument. And they want to do it slowly. They're going to do it kind of under the radar. They want to do a little at a time because they don't want everybody to know what they're doing, right? They have no advantage if everybody's watching them and everybody knows what they're doing. So for those of us that are just sitting and watching our charts, waiting for a trade setup, and we see something like this, we're thinking, well, this is boring. There's nothing to do. Price is channeling. Nobody's trading right now. I think I'll watch YouTube videos or get on Facebook or something because we're bored. We're just sitting there doing nothing. But in fact, something is happening. The big boys are slowly acquiring what they need to make things happen. And so what they're going to do is they have this period of markup so they can mark it up really quick. And they have a particular way they do that. I'm going to show you that in a minute. And then they start taking their profits. Okay? They take profits, or they believe price is still undervalued, or they'll accumulate more at this point. Okay? And they may do that. They may do accumulation, mark it up as a test to see how many people start to jump in and start getting involved. And if not many do, they go, okay, we got room for another markup. Let's mark it up more so that we can now start selling off and taking profits. And then more accumulation, bigger markup, more distribution where they can start taking profits. And then the major markdown starts, and then the whole thing starts all over again. Okay? This is what's happening all day long, every day in every market. Now that you know, you can go back and look at your charts and identify every time it happens. And it's amazing. And because it happens all the time, every day, predictably, we have an advantage because something else happens almost every time predictably. Okay? But pullback trading requirements. Okay? First of all, we don't have to predict. It just happens. So there's no saying, okay, well, I've got my crystal ball out here and all these other market conditions are going on and all these talking heads say we need to do this and all this and that. No, what we do is we sit and wait for a confluence of conditions. And when we have that confluence of conditions, we enter the trade. That's all we do. We sit and wait. We don't have to sit and predict. The system handles all of that. Okay? The indicators handle all of that. We don't have to do any market analysis. We don't have to do any, pre-trading preparation other than, working on your trade plan. We don't have to speculate as to what we think might happen. We don't have to watch TV to listen to the talking heads to tell us what they think is going to happen or why. We're not sitting here guessing that something might happen or hoping that something might happen. We don't have a bunch of money. Exactly. So he's referring to bus stop, which basically all we do is sit and wait, just like if you were sitting and waiting on a bus. That's it. If there's no bus, there's nothing to do. If a bus shows up and it's not the right bus, there's nothing to do. If your bus shows up, you get up and get on it. And that's as much effort as we put into our trading. So we have our signals are yes or no. Does the condition exist? Does it not exist? Not, is it close? It kind of exists, but it's not really great. It's a little bit. It's not. No, we don't do that. It's yes or no. It exists or it doesn't. Okay? So we've got some very simple rules. It takes a very short period of time to learn the rules. You got to have a good plan based on your risk tolerance levels. Exactly. And you've got to practice, because there's a flip side to having such a strong edge. And the flip side is you got to practice. You got to practice your trade entry. And you do that in the evenings. You don't do that during live market hours. That's game time. Practice happens away from game time. At game time, you're executing your trade plan. You're not practicing. You're executing as best you can. And if execution's not good during game time, you figure out what's not good and you go practice that in the evenings or in the afternoon. I don't trade afternoons because, the trade setups are good, but they're fewer. So I'd rather spend that time practicing and honing my skills for the most liquid time in the market, which is 9 to noon. That's when I trade. So I'd rather practice a few hundred or at least dozens of trade setups during the afternoon rather than sit and wait for maybe 2 or 3. So I get my skills up in the afternoon so that I can execute when the markets are most liquid. Okay? So like I said, by reading confluence of the conditions, we just react. So what are these conditions? We're watching what I mentioned on Friday. We're measuring strength so that we can anticipate weakness. Okay? And the strength can be in an up move or a down move. We don't care. We don't care if price is moving up or down. As long as it's moving and people are trading and profit taking is predictable after a certain move, okay? So we're measuring order flow. We're looking for an overbought or an oversold condition. I'll talk about that a little bit more. And again, we're measuring strength to anticipate weakness, exhaustion, okay? And this was the kicker for us. We were already doing well, but as soon as we added in divergence, that's when things really hit the next level. So divergence, for those of you that don't know, is when momentum and price are no longer moving together. Okay? Momentum will generally shift directions before price does. And then price attempts to catch up with momentum after the divergence. Okay? And we know this, and we've been doing this for 15 years. So this was an amazing discovery in adding this to the system that we were already trading really well. So that's what we're looking for. So let's talk about those momentum traders. Okay, the ones that are pushing the markets up. So we've got this uptrend, but each inside the uptrend, we have these patterns, right? That, like I said, go back and look at any chart, and you're going to see this pattern all the time. And it could be a 1 minute, 5 minute, 15 minute, 1 hour. It's still the same. We trade the 1 minute though. So we're looking for a channeling, and then we're going to see a breakout. right? A breakout from the channel, and it's a strong breakout. Notice the size of the bars relative to the size of the bars that are channeling. It's really easy to see, but it's easy to overlook also. If you haven't been looking for it, you may not even be seeing it. You all sit there, right? And we're watching and we're kind of, our eyes are getting heavy and we're watching price moving sideways and nothing's going on and we're getting bored. And then all of a sudden, price starts moving. Either direction, up or down, doesn't matter. Do you ever go, well, what was that? What happened there? Why did price just suddenly start moving? You go, well, maybe it's a breakout. Maybe I should jump in this and ride it to the top. And there are strategies that do that. Okay? But we've got this channeling, and then we've got this breakout, and the momentum traders are causing this. We're going to talk about that a little bit more in a minute. So we're going to look inside this trend, and we see that price is channeling. Now, this could be low interest. It could be accumulation or distribution. We don't know what it is, and we don't care. We only care that it's happening so that we can keep an eye out for when price suddenly jumps out of the channel. All right, so the buying and sentiment increases with a lot of sudden bidding up of price, okay? Momentum traders get triggered, okay? Now, these momentum traders are the guys that will buy high when price is high, and then they'll drive price up and sell it when price is higher, okay? So they don't buy low, sell high. They buy high, sell higher, okay? Now, this bidding up of price suddenly creates a shortage, all right? And buyers begin to become exhausted, and momentum traders start to dump everything as fast as they can before all the buyers are gone. You guys that are jumping into these breakouts, you're the victim, okay? How many times have you tried to jump in a breakout and within a few ticks it ends up going the other direction? They're waiting for you to jump in. They're going to sell you all of their those contracts, and then all of a sudden there's an oversupply because you guys get exhausted. They take all your trades. You guys become exhausted. Now there's an oversupply. And what happens when there's too much of something and not enough people to buy it? What happens to price? It goes down. So I'm like, hey, I got an idea. This was a big aha for me. What I noticed when I started studying this was that after these big bars, there seemed to be a pullback a lot of times. There was a lot of pullbacks. And that was an aha for me. How can I anticipate that pullback? So that's how all of this started. Okay? So let's talk more about the momentum guys. First of all, there's three different kinds of traders out there. There's the value analysis type of people. There's the trend traders, and then there's momentum traders. So the value analysis people are basically trading for they're looking for undervalued stocks or futures or whatever based on fundamental analysis, like things like price earnings ratio and stuff like that. So they're making a study of the intrinsic value of that particular stock or option or futures or whatever. Now there are trend traders who are simply looking for higher highs and lower lower highs and lower lows. Okay, so there's almost no fundamental analysis. It's mostly going to be technical analysis. So it's trends based on historically what happens when you have this type of trend. Okay, so it's based on historical. So we're using technical indicators for trend trading. And then you have your momentum traders, which, remember, it's buy high, sell higher. They like to buy or sell breakouts that are caused by sudden volatility, and they become triggered by this. Okay? So let's look more carefully at this. So we have the value traders, the fundamental traders down here, and they're going, okay, well, we've got an undervalued instrument. Okay, so it's probably time to start accumulating, and we're going to do this slowly. And then there becomes a bidding up in price because other traders start to get involved in this. This is where the momentum traders want to jump in. The price breaks out of this channel, and the momentum traders are like, okay, here we go. Bam, they're going to grab as much as they can, and they're going to shoot it up, and they're going to sell it. Okay? So their profits are not huge on each individual transaction, each individual trade. It's a lot of trades, by the way. They place lots and lots of trades, and you just need to know when they're doing it. Okay, and when it could be something like a news event or whatever. That's two different things. So as it turns out, we can identify who is doing it and when they're doing it. All right. So then they start to sell, and then it happens again. So price becomes at or over value. So this is where the value traders are going to want to get out, right? Because it's overvalued at this point potentially. They bought it when it was undervalued. Now it's at or over value, and then starts happening again. We have low interest, could be accumulation, could be distribution. Momentum traders get triggered. They buy, then they sell. We're at or over value, which means they're going to start selling because it's overvalued again and again and again. So later today, after we're done, if you go pull up any charts, take a screenshot of this and then go look at your charts, and you're going to see this exact thing. So we already have the value traders. They're doing their thing, right? So they have a portion of the market that they're going to exploit. We've got the trend traders. To me, that's a trend trader because I couldn't do it because I just worried too much. Every time there was a pullback in a trend, I panicked and I thought, uh-oh, this is a reversal. I had this much money and now I don't, and I don't know what to do. Should I get out? Should I stay with it? I don't know what. And so to me, trend trading is an exercise in emotion management, and I failed miserably at that. So that wasn't for me. Then the momentum traders, the guys with all the money that can trigger these big trades, then they're not interested. They've already got their portion of the market that they trade. They already have their system. So I started thinking, what's left for those of us that are really trying to find an edge? I wasn't able to do any of those three things. So where's an edge for me? So, like I said, I started looking after these great big bars. So first we have regular small to medium-sized bars, and then suddenly we have a bunch of great big bars. And then after that, price pulled back. And it happened a lot. And I thought, well, how can I exploit that? There's something that I don't hear people talking about very much. These little pullbacks that happen over and over and over again. The momentum traders have no interest in this because it's not much. It's not much to them. And they can't control it the way they can control it on the other side. So we're calling this the backside of momentum. All right, so they're not interested. So let's talk about the confluence of conditions. So if you're in a group and each person in this group is from a different, a different part of society or a different work environment or different skills or different professions or whatever, and they're asked a particular question based on their skills or their personality or whatever. And if you get all this group of people from very diverse characteristics, and they all agree on something, wouldn't you tend to believe that that was probably true, that whatever it is they're agreeing on? So that's a confluence. They're all coming from different walks of life, but they're all in agreement on a particular thing. And that's what we're doing here. We're taking different pieces of information and we're collecting it different ways. But they're all in agreement with each other that price is about to do something specific. And for us, that's change directions in the very near term. Okay? So this is what we're looking for when we're talking about a confluence of events. Now, told you we talk about the rock star. The rock star is our trigger. There's a confluence of events that creates the rock star. Now, we have indicators on our charts for each of those events. Okay? So we do have those indicators, but you could watch them, and so totally up to you. And you say, okay, I have a rock star and I'm overbought and I have divergence. So that equals a rock star. And so for the longest time, we traded it without the rock star. But people were missing it, or they just weren't really getting it. And so I thought, why don't I just create an indicator that just pops up right there at the beginning of the trigger bar, the bar that we would enter on. At the open of that bar, why don't I just have an indicator pop up and say, here it is. All of these conditions exist. There, we have a confluence of these conditions that typically cause price to drop. Okay, so let's talk about the indicators. So you saw in that video a number of indicators, and these indicators each get their information from different sources of data. The indicator that was the very first one that got me to be trading and study and focus on these pullback trades was the speed tick. The speed tick was that little white arrow you guys saw. Sometimes it can be a cyan color. Sometimes it's dark blue. We'll learn about those later after you've decided this is something you want to pursue. There's 3 different threshold levels. We're just going to talk about the white one at this point because that's the one where we feel like that the momentum traders have been triggered and that they're now in the markets. They're now manipulating the market. So what we're seeing is that the orders, not the orders that are being placed, the level 2 stuff, the book orders, those orders that haven't been filled yet, the resting orders, we're not talking about those. We're talking about orders that are actually being processed through the exchange that you could see if you pull up a time and sales window. You can see the orders that are being processed. And if you look at the rate at which they're being processed, you will notice that at a particular rate, it's nearly impossible for retail traders, that's us, me and you, it's impossible for those orders to be executed by us little guys on our PCs at home using our internet connections thousands of miles away from the exchanges. So you have to make the assumption that, well, if it's impossible for us to be doing it, It's not impossible for the big boys that have all the money, all the power, and they're either inside the exchange or next door to the exchange. So they can operate in milliseconds. So they have certain advantages we don't have, which causes them to be able to execute these orders really fast. Now, they don't really want us to know what they're doing. They do enjoy some permissions from the exchanges in exchange for creating some liquidity in the markets. So they're required not to hide completely, but they can still try to hide as best they can. Okay. So these market manipulators are kind of flexing their muscles, but they try to hide. But if you know where to look, you can find those footprints in the sand that are the big boys, and you can easily spot them, and then you can understand what is likely going on, which means you know what is likely to happen next. So that's where our speed tick comes in. When we get a speed tick on a bar, we know that bar is probably being manipulated. And we know what's likely to happen next. Now, we're not just going to trade based on that, although there are plenty of trading systems that will trade on just that. We're going to look for more confluence from other indicators, like our OBOS. We call it OBOS, overbought, oversold. So I said I'd mention this later, and just like in the real world, when we have too much of a product and there's not enough buyers for all of this product, what happens to price? When price gets when the product gets overbought, meaning there's too much of it out there and not enough buyers, price is automatically going to come down to try to find those buyers until they get to a point where they may have sold a bunch, and they get down to the point where now they're sold out, but there's buyers left. Price is oversold. Price is going to go up. Okay? So this, I don't know how many of you understand that this is an auction. When we're trading, it's an auction, and we're bidding against other people based on how many of a particular instrument is available at that time. So it's important for us to know that, because we're looking for when we have a strong potential for exhaustion. We want to know when price is becoming overbought or oversold, because that means exhaustion has set in. Exhaustion meaning there are no more buyers or sellers at that price. Okay? Very important, because price almost always stops and changes directions when it becomes overbought and oversold. Simple. This is so simple. Okay? It all makes perfect sense when you try to think about what's going on. This is for you people that like to look under the hood and understand what's the logic of what's going on, and not just that this works, but how and why it works. And this is one of the reasons. Okay? Our mo meter, you saw that. You know that price never runs in one direction, right? Our mo meter is when the indicator, the bars start painting black, and the longer it goes, the lighter the bars get. Okay? The lighter the bars get, the more imminent the pullback. So price never moves in one direction. People will always start taking profits after price has made a strong move in one direction or the other. Okay? When people start taking profits, price slows down and changes directions, even if it's just for the short term. Okay? So we want to, again, measure strength to anticipate weakness. So that's our millimeter indicator. We can, right where price is getting exhausted, we can anticipate it's going to pull back. Speaking of pullback, we have our pullback alert. We get a lot of questions when people come in the room. I'll get emails and such to say, hey, why don't you watch volume? You don't have a volume indicator on your chart. And everybody watches volume. Guess what? The big boys know everybody is watching volume, which is why they do what they do the way they do it. Okay? We do watch volume, but we're only interested in a specific type of volume. Okay? So here we've got two bars, both created by volume, identical, but the volume that comes into the bar is very different. So for the first bar, the volume comes in tick by tick, and there's nothing really specific going on. Price goes up, hits a high, backs up, closes at at that price. Okay, nothing really special going on, but it's volume, and it's a particular amount of volume. Now we have the same amount of volume in this bar, but the volume that's coming in is churning. It's the buyers and sellers are obviously fighting with each other. All right. So the volume is churning. And when we see that, we know that if all of these are buyers, they're likely, as prices going up, they're likely to be becoming exhausted. And then the sellers that are sitting up in here waiting begin to try to sell, but they're still buyers, but they're sellers. There's buyers, there's sellers. So they're fighting. But if the buyers are particularly exhausted, and now we're hitting the end of the available buyers, price will often change directions right here because of this churning activity. So that's what we're looking for. And that's where our pullback alert comes into play. That's the dot. You guys saw that colored dot on top of the bars. Okay. These are our support and resistance lines that you asked about. All right. So if you're not familiar with support and resistance, basically they're imaginary lines. They have no value at all. There's there's just lots of different algorithms for creating support and resistance lines that a lot of people use, and they believe that there is, for some reason, support or resistance in these areas, and so they don't want to cross these areas. Now, the fact that people believe them gives them significance. It means that that line is probably going to work and offer some support or resistance only because people believe that it will. And they're paying attention to these areas of support or resistance. So if the rest of the market is paying attention to those areas of support and resistance, we should too, because we know that they're afraid to push price right across those lines in a lot of circumstances. Okay. So we use that to our advantage. I showed you in one of those videos how we place a trade, and then it went against us a little bit, bounced off that resistance, and then went in our favor. We see that every day. We saw it yesterday in a trade group. Okay. So we should pay attention to these lines. Our super D, this is our divergence indicator. So is the support and resistance line equal to the top and bottom of the, no, that's two different things. Two different things. The naked rockstar zone is a channel that we don't want to really trade in because we don't have a strong potential for exhaustion. The support and resistance lines are essentially, they're going to be either floor trader pivots or mid pivots or a couple of other lines that everybody looks at, like yesterday's high and close and things like that. So they're nothing special other than the fact that we have added some some nice tools to them to help you understand how strong that line might be. So we have this potential strength indicator, the numbers at the end of the line, that gives you an idea of how strong we might expect price to react to that line if it approaches it in a very strong fashion. Okay? So the super D is when price and momentum get out of sync with each other. Typically, price and momentum run together. Price will run this way and momentum will run this way. And so you see they're in sync with each other here. And that's very typical. But sometimes they get out of sync with each other. So here you can see that momentum is actually going up while price is still going down. Okay? Most times when that happens, when divergence happens, price is going to try to catch up with momentum. So price will have to change directions to catch up with momentum. Okay, so we've identified another area that if we have divergence, now we wouldn't see this. We wouldn't see, except by using some of our other indicators, we wouldn't see that this line is going to stop and change directions unless we're taking momentum measurements and then measuring it against this line to see if our momentum has changed directions or not. So that's what our Super D does. We're measuring to see if momentum has changed directions yet. And if it has, we're going to put that condition on the chart with our Super D. Okay, so the ricochet, another great indicator. So I mentioned to you about the speed tick, about the speed of ticks coming into the market can let us know when the big boys are trading, right? And are probably manipulating the market. Ricochet is very similar, but it's not measuring the speed. It's measuring the acceleration. Okay, so for those of you that maybe don't quite understand the difference, speed, let's just say, is 100 miles an hour. So for the speed tick, we're measuring to see if those orders are coming in at 100 miles an hour. With the ricochet, we're looking to see how fast it accelerates. And if price accelerates from 0 to 80, that's really fast. So that's acceleration. Now, it may not get to 100 miles an hour where it qualifies for a speed tick, but the acceleration, again, was such that it's unlikely retail traders were able to accelerate price that fast. It's not like we're all on the phone with each other and saying, okay, everybody buy now, right? So it's unlikely that the acceleration was caused by us retail traders. So if anything that's being done is done by the market makers, we want to know because they're doing it for a reason. And if we know when they're doing it, we know what's going to happen next. Okay? So again, the anatomy of our pullback trades, right? Price breaks out of a channel. We get strong momentum during the breakout, which is these bars start getting bigger and moving hard, turning from black to gray to light gray to almost white. We get a speed tick saying that the momentum traders have been triggered. This is the dot I was talking about for the pullback alert. The initial buyers are giving way to the sellers that are coming in, which is the churning activity that's going on. This is also would be considered a climax bar. Okay. Then at the open of the next bar, we have our rock star, which says that we have a confluence, speed tick, potentially the oboes, and divergence. And boom, there's our order entry or better. We want to enter at the open or better. So hopefully you identified that the bar opened here. You went to put your trade on, and by the time you did that, price has moved up to right here, and you get filled here or better. I get or better fills at least half the time, or if not more. All right, because there's not always the price doesn't always turn on the tick of the open of the bar. It has what we call sometimes some freight training. There's still some buyers lingering that are putting on orders here, and so we'll get a chance to sell it up in here maybe. All right, so eventually those buyers become exhausted and price has to drop. Okay, so that's we sold it here in this example. So look here, and this is what you see on all your charts. Price breaks out, strong momentum, price gets overbought. That's the pink outline. Momentum traders get triggered. That's the speed tick. The initial buyers are giving way to the sellers, and that's this pullback alert. We get divergence. Profit takers start jumping in, and we took the trade right here. And here, this is another trade setup. This is called a naked speed tick. This is our climactic volume indicator. This is our medium blue speed tick. So it's essentially the same trade, but with slightly different rules. Okay. And we're looking for the same thing. So we took this trade, we shorted it right here. We took, again, this trade right here. We shorted it. Another trade here. We shorted it. Okay. Same thing over and over and over again. We're trading for 5 ticks. 5 ticks is the sweet spot. Okay. There's a low need for emotion control when you do this. We're in and out of trades so fast most of the time that the whole reason I came up with this system, like I was telling you earlier, I was a horrible trader and I worried all the time. I panicked. It was horrible for me. Every day I just like, I was just emotionally drained every day, to the point where I realized, well, I got to quit trading because I just don't have the emotional strength to handle this. So I started rethinking it. I said, what would it be like to trade without having to try to manage my emotions? How would I do that? And basically, the less time I'm in the market, the less I have to try to manage my emotions, right? I want to get in and out. The longer you're in a trade, the more speculative that trade becomes, because you don't know what's coming into the market from 1 minute to the next. To put on a trade now and hopefully it does what you hope it's going to do an hour from now doesn't really seem to make a lot of sense, because there are so many influences in the market that can change. All the conditions that got you into the trade can change immediately. Now, are you supposed to sit there and wait and see if those changes in the conditions are going to cause your trade to go bad? I mean, a lot of trading does. A lot of rules do. When the conditions change, you're supposed to just ride it out. But you don't maybe know, unless you're measuring for those conditions or you're looking for those conditions, you don't know that they've changed. You're just sitting there hoping that your trade wins. So I had a hard time with that. So I thought, well, how can I get in and out quickly so I don't even have to think about my emotions? And that's where this came from. So it creates a very low stress type of trading. Stress is created when you're in the markets. I want to stay out of the markets as much as possible, because then I can relax and I can get ready for the next trade setup. And there's no shades of gray as far as making a trade decision. You get yes or no. I went over that on Thursday. If you haven't seen the video on Thursday, go watch that, and you'll be able to see how the yes or no decision making process is how we go through that process. Okay. There's really no complicated trade management. We just shorten our stops if the conditions that got us into the trade has changed to the point where we might get up to break even or +1 or +2 or whatever. We're just trying to manage our stops shorter. So there's no complicated, putting on runners or scaling out or anything like that. It's a hard target trading. And you can do this with single contracts or multiple contracts. And there's no different rules for each instrument. It's all the same. Trade as many instruments as you want. All the rules are the same. The idea with what we do, with what I teach, is that you're not trading for money, because I also made sure that I figured out that I had an unhealthy relationship with money as it related to trading, and that all of my emotion management was related to money. Everything was about money. That's all anybody ever thinks about, is about money. And I started thinking about that, and I started thinking, well, if trading is supposed to be a profession, and that's what people are wanting to get into trading for, including myself at the time, I want to get into trading to make it my profession. Are other people, when they're in their profession, always thinking about money with everything they do throughout their work day? Is it always about money, or is it about doing their job? Just doing their job and knowing that if you do a good job, at the end of that, you get money. It's a byproduct. Money is a byproduct of doing a good job. So I started thinking about that, and I started applying that to my trading, that when I sat down to trade, I was just doing my job as the lead trader of my trading company. And my job is what? What's my job? You should all know this. What's my job when I sit down to trade every day? What's my job? Perfect. Right. That's it. Winning trades is not my job. Is winning trades my job? That's not my job. And guess what? When I put on a trade and it loses, was I wrong to enter that trade? Was I wrong? You're only wrong if you're guessing. If you're guessing that the price is going to go up or down and it doesn't do what you guessed it was going to do, then you took a wrong guess. But if I have a trade plan and I execute the trade according to the plan and that trade loses, I wasn't wrong. I did exactly what I was supposed to do. And fortunately, because I've been doing this as long as I have, I know that the odds are in my favor. I will take losses. It's guaranteed. It's part of the plan. I will take losses. You cannot filter out losses. You're going to take losses. But I also know if I execute the plan, I'm going to take more winners than I have losers. So I'm playing an edge. Okay. All right. So I mentioned the video from Thursday. If you haven't seen it, you can go and see it here. Here's a link that I'm going to put into the chat here. And if you're watching this on video, I'll put it in the description down below, or it was probably in an email that you got. How many days? I will go net -3. I don't know. You guys in the trade room, what is it, like 3 days a month? Maybe 3 days a month I'll hit my net 3. Sometimes it's like amazingly fast when I do it too. I might be in the trade room for 3 minutes and boom, boom, boom. I took 3 trades. They were all losers and I'm done for the day. Occasionally I've had 2 days in a row where I've done that. Almost never 3 days in a row. Almost never. I can't even remember when I've had 3 days. Maybe last September. It was, things were kind of wonky last September, but we all made it through it, and then the markets turned around, and things got better. So I might have had 3 losing days in a row in September last year, but it's rare. It's very rare. But yeah, maybe 3 days a month. So that's pretty good. And I'd say that's probably the same for a lot of people in our trade room. All right. Also, if you guys want to see more of those videos that I showed at the beginning of this event, go watch our Trade of the Day videos. All right. And you can find them on our YouTube channel here. There's a playlist called Trade of the Day videos, and you'll see just tons and tons and tons of those videos. And eventually it starts looking like the same trade over and over and over again, because that's all we do, over and over and over again, and have been for like 15 years. People always want to ask me, what about when it changes? What about when the big boys catch on to what you're doing? They don't care about us. Like, we're small potatoes. They don't care about us. We're not harming them one bit. All right. So you can go watch a bunch of those videos. I'm going to offer you guys a special offer. Here's a link to our store right here. I'll put that in the chat. Here is the coupon code. I'll put that in the chat. And for until the end of next week, I think, we'll give you this discount on any of our programs. Okay. So look into that. The Pro Trader program is by far the most popular because it gives you the biggest bang for the buck. You know, you get every indicator that we've ever developed. You get every indicator that we will ever develop in the future. You get our essential add-on suite, which has 13 different tools to use in NinjaTrader in it, including our data replay downloader. You get that for free. You get you could join our Trader RX program, which is a peer mentoring program. You get priority support. You get free trade room for life. You get access to all of our trade room videos that we've done over the last several years. You get access to our trade setup log that we keep for your practice sessions. Lots and lots and lots of tools. Our Fast Forward program with lots of training and other tools to use in your practice sessions. It's like we're just constantly trying to create more and more value and just adding it into the Pro Trader program, because really, if you're ready to jump into this and you want to get fully immersed in it, that's the way to go. Certainly, we offer the other couple of programs for people that want to kind of ease into it. Maybe they don't want to get involved in all the other stuff. They just want the indicators to help augment some trading that they're already doing that's relatively successful, or just want to kind of add things to what they are already doing. So that's kind of what we have the other two programs for people to help them kind of get started with us, test us out, see if we're real. And then it's not uncommon for people that get started with us in the starter or the extra income to upgrade to the Pro Trader because of the value that it gives. Now, 100% of your purchase of any program gets applied later to an upgrade. So anything that you spend today and then you want to upgrade, 100% of your payment gets applied to that upgrade. The only thing that doesn't apply is if you're in a payment program, either one of our subscription things, like we do have a subscription trade room. That doesn't apply. We do have subscriptions to our essential add-on suite, so that doesn't apply. But anything else that you purchase for like indicators, it will apply towards the upgrade. All right. Thanks, Willie. All right. So any other questions? You're all good? It was a quiet group. I must have done an excellent job. Didn't have a lot of questions. Thanks, Rose. I will be sending out the video later this afternoon. For those of you that didn't get a chance to stay or want to review it again. Thank you very much. All right. Well, if you don't want to ask questions here in the chat, or you're watching this on video and you want to ask questions, go to support@theintentionaltrader.com and send us an email. No, we don't recommend trading any one particular indicator, Joe. What we're recommending is that you use that as confluence with other indicators. So you're looking for a confluence of conditions, not just a condition. Okay, that's where what really kind of sets us apart from a lot of other programs. Is a lot of programs have their divergence traders, or their order flow traders, or their momentum traders, or their whatever. We combine all of that into a single system. So we want all the agreement. Remember all those people holding their hands up saying they agree? We want agreement with a lot of different sources of data suggesting that something is about to change. Specifically, price is about to change directions. So I wouldn't trade just an indicator. Okay? All right. Well, thanks, everybody. I appreciate you coming out on your weekend. I hope you have a great rest of your weekend, and hopefully we'll see you all very soon. Bye-bye.